Welcome, curious minds, to another deep dive. Today, we're plunging into the fascinating and frankly electrifying world of D-Wave Quantum Inc., trading on the NYSE as QBTS.
It's quite a story, isn't it?
Absolutely. I mean, this is a company that has seen its stock soar by over 1,600% in the past year. They've even claimed a genuine quantum advantage over the most powerful supercomputers on Earth.
Which is quite a claim.
It is. But that meteoric rise, it begs a crucial question. Is its current valuation a brilliant quantum leap into the future? Or is it perhaps a quantum leap too far from reality for a traditional investor?
That's the core tension, really.
Our mission here, as always, is to cut through the noise, extract the most important nuggets of knowledge from our sources, and help you become truly well-informed on this incredibly complex and, let's face it, often speculative stock. We're working with an analysis date of July 31st, 2025, when D-Wave shares closed at $70.19. And just a quick heads up before we get too deep, D-Wave Quantum Inc. is scheduled to report its Q2 2025 financial results on the morning of August 7th, 2025.
Right, and you should definitely stay tuned for that.
We will absolutely be covering those earnings within minutes of their release, so keep an eye out.
It's true, this topic can be dense, even for us sometimes, but our goal is really to simplify, to connect the dots, and provide you with clear context so you can truly understand what's at stake with a company like D-Wave.
Okay, let's unpack this. We'll start with the company's foundation, get into the internal dynamics, Chapter 1, business analysis. So, what exactly is D-Wave's business model? How are they actually trying to make money from this pioneering quantum tech?
Well, it's quite multifaceted, actually. They primarily have three revenue streams. The most established is their quantum computing as a service, or QCS.
QCaaS.
Yeah, that's their cloud-based Leap platform. It gives users access to their quantum computers, and it's their main source of recurring revenue. Made up, over 3/4 of their total revenue last year, 2024. So about $6.7 million of $8.8 million total.
Okay, recurring revenue, that's key.
Yeah.
What else?
Then there are their professional services. This is through the D-Wave Launch-It program, basically offering consulting, application development, integration help. That was about $1.9 million last year, so maybe 22% of the total.
But here's where it gets really interesting, I think.
Uh,
The direct sale of their quantum systems. I noticed a huge spike in their Q1 2025 revenue from one of these sales. Was that a one-off? And what does it mean for their future revenue picture?
You're right to notice that. That was huge. Their first ever Advantage quantum computer sale, it went to the Jülich Supercomputing Center in Germany.
How much was that for?
Over $12 million. And that single sale, it single-handedly shot their Q1 revenue up by over 500% year over year.
Wow, 500%.
Yeah. It's incredibly lucrative, obviously, but it also really highlights how, well, lumpy and unpredictable their revenue might be if it relies too much on these infrequent, massive system sales. It's quite different from steady, recurring revenue.
Makes sense. So beyond the sales model, what's inside their full-stack ecosystem? What are the key products they actually offer?
They offer the whole stack, really. Hardware, like their Advantage and the newer Advantage 2 quantum computers. These use qubits. Think of them as the quantum version of traditional computer bits, and they're specialized for incredibly complex optimization problems. The Advantage 2 has, over 4,400 qubits.
And how do people access these?
That's primarily through their Leap Quantum Cloud service. It's the main delivery vehicle, boasts really high availability, like 99.9%, and it lowers the barrier to entry for users.
And for developers.
Right, for developers, they have the Ocean Software Development Kit. It's an open source set of Python tools available on GitHub and through Leap, designed to simplify building quantum applications.
They're definitely considered a trailblazer, founded way back in 1999.
Yeah.
What's special about their market position now, and who are some of their key customers today?
They really are pioneers, yeah.
Right.
Billed as the world's first commercial supplier of quantum computers. They also have this unique dual pathway approach.
Dual pathway.
Meaning they're developing both quantum annealing and gate model quantum computers. Most competitors focus on one or the other. And their customer list is pretty impressive. Over 130 paying clients now. Includes big names like Volkswagen, Lockheed Martin, Ford Otosan, Deloitte, NEC.
That's serious validation, having names like Lockheed Martin and VW using your tech.
Definitely lends credibility.
Now, what's fascinating here is D-Wave's primary value proposition. You mentioned annealing versus gate model. Many competitors are racing to build those gate model systems, the general purpose, sort of future supercomputers. But D-Wave has carved out a specific niche. How would you describe that differentiation?
Yeah, that's key. They're really focused on delivering the fastest path to practical, real-world quantum value today. That's their mantra.
Practical value today.
Exactly. So instead of aiming solely for those universal quantum computers way down the line, they specialize in quantum annealing. Think of annealing as a super solver, specifically designed for complex optimization
Like
problems.
what kind of problem?
Things like logistics, financial modeling, drug discovery, materials science. It's not a universal computer, but it's practical for certain very hard problems today.
And this focus has led to some big claims.
It has. This focus allowed them to achieve what they called quantum computational supremacy on a useful real-world problem, basically performing a complex magnetic materials simulation in minutes that they claim would have taken a top classical supercomputer like Frontier nearly a million years.
A million years versus minutes. That's quite the statement.
It's a powerful demonstration of annealing's potential for specific tasks, definitely.
Okay, zooming out a bit, the whole quantum computing sector feels like it's at a critical inflection point.
Hmm.
What are the big market trends and growth projections looking like here?
Absolutely. This industry is really poised for exponential growth. You see market forecasts projecting the global market to reach, $5.3 billion by 2029, maybe even up to $12.6 billion by 2032. That's a CAGR in the mid-30s.
Huge growth potential.
Massive. And some projections put the total economic value created by quantum computing at over $1 trillion by 2035. Key trends driving this are the convergence with AI and machine learning, the dominance of cloud-based services like QTaaS, and just a massive surge in global investment. We're talking tens of billions in public funding, plus billions more in private VC money pouring in by 2024.
Sounds like a gold rush almost. So who are D-Wave's main competitors in this rapidly expanding field? Who are they up against?
Well, there are really two main groups. First, you've got the other pure-play quantum companies like Rigetti Computing, RGTI, and IonQ. Though it's worth noting they primarily focus on gate-based quantum computers, unlike D-Wave's annealing focus.
Okay, the specialists. And the second group.
The second group is the big one, the incumbent tech giants. Think Google, IBM, Microsoft. They're pouring billions into their own quantum R&D efforts, mostly aimed at universal quantum computers.
And they pose the biggest threat.
With their vast resources and talent pools, yes, they pose the most significant long-term existential threat to a smaller player like D-Wave.
Beyond the competition, are there any external forces shaping this market? Things like regulations or barriers to entry?
Definitely. The regulatory environment is still nascent, but it's evolving rapidly, mainly because of national security implications, especially around cryptography.
Cryptography, right. Breaking encryption.
Exactly. So you're seeing increasingly stringent export controls, particularly from the U.S. Department of Commerce. They put new rules in place in September 2024 on quantum technologies, requiring licenses for export to certain countries, specifically aiming to prevent acquisition by China and Russia.
How does that impact D-Wave?
Well, it directly impacts supply chains and international collaboration, potentially limiting their total addressable market. And as for barriers to entry, they are exceptionally high.
What makes it so hard to get into this space?
Several things. One, the technology itself is still immature. We're in what's called the NYSE era, noisy intermediate scale quantum. Qubits are fragile, prone to errors, decoherence. Quantum error correction is a massive ongoing challenge.
So the tech is just hard.
Extremely hard. Then there are the prohibitive capital costs. You need massive R&D investment, highly specialized infrastructure, like those cryogenic dilution refrigerators that cost millions. And finally, there's a severe global scarcity of specialized talent, quantum physicists, cryogenic engineers, specialized software developers. It's a very small pool.
Okay, so given all these challenges, tough tech, big competitors, high barriers, what's D-Wave's actual competitive advantage? Their moat, if you will.
Well, their history helps. That world's first commercial supplier narrative gives them strong brand recognition and consistent media presence, like features in the Wall Street Journal. Plus, validation from clients like Lockheed Martin, VW, Ford, Otosan definitely builds credibility.
Do they have cost advantages? Economies of scale?
Not really in the traditional sense. Production is very low volume, very high cost, but they might achieve something called quantum economic advantage.
Quantum economic advantage, what's that?
It's the idea that they could solve certain types of problems so much more cost-effectively than classical computers that they essentially become a sort of monopolist for specific types of calculations. It's a fascinating, though still theoretical, concept for now.
Interesting. And what about sticky customers? Are there network effects or switching costs involved here?
There are some nascent network effects building up around their open source Ocean SDK community, but more tangibly, I think there are significant switching costs.
How so?
Well, once a company has invested significant time and resources developing quantum hybrid applications specifically tailored to D-Wave's unique annealing architecture, migrating those applications to a competitor's platform, especially a fundamentally different gate-based system, would be incredibly complex and expensive. That definitely helps create a sticky customer relationship.
So it sounds like their deep expertise in quantum annealing specifically is their secret sauce right now. But is that a permanent moat?
That deep expertise, combined with their robust IP portfolio, they have over 250 granted U.S. patents that forms their practicality moat. They're delivering tangible value now, while many competitors are still focused on building for the more distant future.
But not permanent.
Right. It's a moat for today, but it isn't permanent. Universal gate-based quantum computers are widely seen as the ultimate prize in the long run. D-Wave knows this, which is why their own gate model research is essentially a defensive strategy, a hedge for that future.
All right, let's switch gears now. Chapter 2, Management Evaluation. Let's talk about the people behind the technology. Who's at the helm at D-Wave, and what's their track record look like?
The leadership team seems quite seasoned. Their CEO is Dr. Alan Baratz. He took over in 2020 and has a pretty strong background, notably scaling the Java platform back at Sun Microsystems. He also held executive roles at Cisco and IBM.
Okay, experienced tech leadership. How about the finance side?
Their CFO is John Markovich. He brings over 30 years of financial leadership experience, involved in, apparently, over 150 transactions worth more than $2.5 billion. So, deep finance background.
And how has the team handled challenges?
Well, the average tenure on the team is relatively short, about 2.7 years, which might reflect the changes around going public via SPAC. But they have successfully navigated some challenges, including resolving a NYSE non-compliance issue late last year regarding their stock price.
Now, on the surface, their communication seems pretty standard quarterly financials earnings calls. And the CEO, Dr. Baratz, even stated back in the Q1 2025 earnings call that he believed they had sufficient cash to fund profitability. That sounds like strong confidence from leadership, right?
It does sound confident, yes. That's the kind of statement investors like to hear.
But then we see something else when we look at insider activity. What's the potential disconnect there?
Yeah.
What's the real story?
Yeah, that statement about funding to profitability sounds good, but what's really caught our eye, and frankly, it has to be considered a potential red flag, are the significant insider stock sales.
Significant how?
In May 2025 alone, CEO Dr. Baratz sold shares worth about $14.4 million, and CFO John Markovich sold shares worth around $6.9 million. And over the last 3 months leading up to our analysis date, total insider sales topped $27.8 million.
Wow. Nearly $28 million sold by insiders in just 3 months.
Exactly. And while executives might sell stock for various personal reasons, diversification, taxes, whatever large-scale selling like this, especially at these elevated valuations after a huge stock run-up, can certainly be interpreted as a lack of conviction from management about significant further upside from the current price levels. It raises questions about alignment with shareholders. It's a noteworthy point of concern.
Definitely something to watch. Okay, so how are they allocating the capital they do have? Are they buying back shares, paying dividends, or is it all going into growth?
It's very clearly focused on aggressive growth, not on returning capital to shareholders right now. You see it in their spending. Q1 2025 R&D was over $10 million. Sales and marketing almost $7 million.
And that big equity offering they did recently?
Right. That $400 million at the market, or ATM, equity offering completed in June 2025 marked a significant shift. They explicitly stated the primary use of proceeds would be for strategic acquisitions.
M&A.
Yeah, signaling a potential M&A-driven growth model going forward, which, of course, comes with the potential for further shareholder dilution from issuing stock. As you'd expect for a company like this, there's no history of share buybacks, and they do not pay dividends at this time. No indication that will change soon. All capital is being reinvested into growth initiatives.
And when we look at their return on invested capital, or ROIC, which measures efficiency, what does that tell us?
Well, as you'd probably guess, it's deeply negative. It was around medical 229% in Q1 2025 and negative 350% on a trailing 12-month basis. Yeah, but that's pretty much expected for a pre-profitable company that's investing so heavily in R&D and scaling up. It did improve significantly from the negative 875% in FY 2024, largely thanks to that big Q1 system sale boosting the numbers. But future improvement in ROIC is absolutely a critical indicator to watch as they try to scale towards profitability.
Okay, let's move on to the financials themselves. Chapter 3, Financial Analysis. Now, for the numbers, let's crunch some key metrics, starting with their market capitalization. As of our analysis date, July 31st, it was around $5.5 billion, putting them in the mid-cap range. What does that $5.5 billion figure tell us when we compare it to their current revenue?
Well, that's where the story gets really interesting, or perhaps concerning, depending on your view. That market cap, roughly $5.5 billion, sits against trailing 12-month revenue of only about $21.36 million.
$5.5 billion market cap on $21 million revenue.
Exactly. So the valuation is exceptionally high relative to current sales. It clearly reflects immense investor optimism about the future, not their current operational scale.
And their revenue growth, you mentioned, it's volatile. We saw that Q1 spike driven by the system sale. How has the trend looked over, say, the last 5 years?
It's been inconsistent and volatile, yeah. Growth was about 22% in 2023, but then slowed dramatically to less than 1% in 2024, with total revenue just $8.8 million for that year. Then, boom, Q1 2025 comes along with $15.0 million in revenue, that huge 509% year-over-year increase we talked about.
Driven almost entirely by that one-time sale.
Almost entirely, which is why extrapolating that single quarter's growth rate into the future would be highly misleading. You really need to look at the underlying recurring revenue growth.
Okay, let's look at profit margins. It seems like they tell a tale of two extremes. Gross margin looks strong, but operating and net margins are, well, not so strong.
That's exactly right. Their gross margin is actually exceptionally strong. It hit a record 92.5% in Q1 2025, up significantly from around 63% in FY 2024. This shows that their core products, when sold, are inherently highly profitable at the gross level. But when you move down the income statement to operating margin and net margin, they remain deeply negative. Operating margin TTM was negative 332%. Net margin TTM was negative 618%.
Minus 618%.
Yeah. It reflects the heavy spending on R&D, sales, marketing, and admin costs required to build the business. They are very much pre-profitability with a long road ahead to reach the bottom line.
And their free cash flow. You mentioned earlier it's consistently been negative. Is this a major concern for their stability, or is the cash pile enough for now?
They do have a consistent history of negative free cash flow, yes. Cash burn was around $58 million in 2023. Now, they did show a significant positive swing in free cash flow for the full year 2024, reporting about $29 million positive.
How did they manage that?
Well, that positive figure was likely driven by financing activities, specifically cash raised from their ATM equity offerings rather than operational improvements. Because when you look at Q1 2025, free cash flow is negative again, about $19.7 million. So the underlying operational cash burn continues pretty much unabated.
So putting it all together, consistent losses, cash burn, but a lot of cash raised. How stable are they financially, really?
From a pure financial stability perspective, despite the ongoing losses and cash burn, their balance sheet currently looks like a fortress.
A fortress? How so?
Their debt-to-equity ratio is very low, around 0.15, so they're relying almost exclusively on equity financing, not debt. They ended Q1 2025 with substantial cash, about $304 million, and that jumped to around $815 million after that big $400 million ATM offering closed in June.
$815 million in cash.
Right. That cash hoard far outweighs their long-term debt, which was only about $36.6 million. And their current ratio, which measures short-term liquidity, is extraordinarily high at 20.73.
20.73. That's huge.
It is. It indicates an extremely strong liquidity position, driven primarily by that large cash balance. So they have a very long financial runway to fund operations and investments without needing to access capital markets again immediately. And as we mentioned, they don't pay a dividend. All that capital is being reinvested into growth.
Okay, now for the big, possibly unanswerable question. Valuation. How do we even begin to value a company like this, especially when it's not profitable? Traditional metrics seem tricky.
You're right. Traditional metrics like the price-to-earnings PE ratio are essentially useless here because they have negative earnings. Their PE is something like negative 28, which isn't meaningful.
So what can we look at?
The price-to-sales PS ratio is more appropriate, though still challenging. Using the $5.5 billion market cap and $21.36 million TTM revenue, we get a PS ratio of roughly 257x.
257 times sales.
Yes. which is exceptionally high.
Yeah.
If you compare that to other rapidly growing tech companies or even established giants like Microsoft, it signals a substantial premium. The market is essentially pricing in decades of flawless execution and massive market capture already.
We often talk about DCF, discounted cash flow, as a way to try and estimate intrinsic value. Can we even apply that here? And if so, what does it suggest?
Well, we have to be extremely careful here. Any discounted cash flow model for a company like D-Wave is inherently speculative, maybe even bordering on fictional at this stage. Its value is almost entirely dependent on making assumptions about revenue growth, profitability, and risk far, far out into the distant future.
So, huge grain of salt needed.
A whole salt shaker, maybe. That said, running some models based on different scenarios can give us a sense of the range of possibilities, however uncertain. One relatively conservative educational model we looked at actually estimated an intrinsic value as low as $0.44 per share.
44 cents, that's way below the current $17.
It is. Now, if we try to capture a much more optimistic bull case scenario, assuming they execute perfectly, capture significant market share, and achieve high margins, a plausible, albeit still highly speculative, intrinsic value range might stretch somewhere between, say, $2 to $25 per share.
$2 to $25, that's an incredibly wide range.
It is. And that wide range truly emphasizes the profound uncertainty involved in valuing this company today.
And just to be clear, what kind of heroic assumptions do you need to make in a DCF model to even get close to the current $17 valuation, let alone the top end of that range?
You'd need to plug in some truly highly optimistic assumptions. For revenue growth, you'd need extremely high, sustained, and accelerating growth rates, perhaps 50%, 60%, even 70% annually for the next 5 to 10 years. That's well above the current analyst consensus forecast, which is already optimistic at around 36.6%.
And the discount rate?
You'd also need to use a very high discount rate, probably in the 15% to 20% range, maybe even higher, to adequately account for the immense risks involved. The risk of technological failure, intense competition, the very long and uncertain path to profitability, and the stock's inherent high volatility.
So to kind of put a bow on this whole valuation discussion, this isn't your typical investment profile, is it? Yeah.
No, absolutely not. D-Wave's profile is not that of a traditional investment. This is much more akin to a venture capital style bet. It's a highly speculative wager on the company capturing a dominant share of a potentially massive multi-trillion-dollar quantum computing market decades down the road. It's fundamentally at odds with traditional value investing principles.
Okay, let's transition now to the second part, looking at some external factors and the overall outlook for D-Wave. Chapter 4, Market Sentiment. What are the Wall Street expectations looking like ahead of those Q2 earnings on August 7th? What are analysts forecasting?
For Q2 2025, the consensus earnings per share EPS forecast is somewhere between -0.06 and -0.07. That would actually be an improvement from the -0.10 they reported in the prior year quarter.
Okay, slight improvement on the bottom line expected. What about revenue?
Revenue is the interesting one. The consensus forecast for Q2 revenue is only around $2.55 million.
$2.5 million. That's a huge drop from the $15 million in Q1.
It is a dramatic sequential decrease of about 83% from Q1's $15.0 million. But what this shows, I think, is that the market correctly identified that Q1 surge, driven almost entirely by that one-time system sale, as anomalous. Analysts aren't extrapolating that massive growth.
So the focus will be elsewhere.
Exactly. The market's focus for Q2 will likely be squarely back on the core QCaaS recurring revenue growth and any commentary management provides about the pipeline for future system sales.
Beyond the specific quarterly numbers, how is the market generally perceiving D-Wave? Analysts seem overwhelmingly bullish, and the media tone has been pretty positive lately.
That's true. Looking at analyst ratings, it's pretty much overwhelmingly bullish. Out of 10 analysts covering the stock around our analysis date, the consensus was a buy or strong buy. There were literally no hold or sell ratings.
All buys. What about price targets?
The average 12-month price target was somewhere between $16.70 and $19.38, so slightly above or around the current price. However, there's significant dispersion in those targets, ranging from a low of $12 all the way up to $30.
$12 to $30 is a big range, even for the bulls.
It really highlights the high degree of uncertainty, even among those who are optimistic about the company's prospects. And yes, the recent news flow and general media tone have been predominantly positive, fueled by bullish analyst initiations, that quantum supremacy achievement announcement, and of course the huge 509% Q1 revenue beat. Headlines were even drawing parallels to NVIDIA's dominance in AI, framing QBTS as a potentially key player in the next technological revolution.
Okay, so analysts are bullish, media is positive. But if you look at some other market indicators, like short interest, there seems to be a different story bubbling under the surface. What does that tell us?
Ah, yes, the short interest. It's extremely high. As of our analysis date, short interest as a percentage of the float was 20.51%.
Over 20%, that's huge.
It is. That means over 60 million shares were sold short. This signifies a deeply pessimistic view from a large and presumably well-capitalized contingent of market participants who are betting against the stock. It makes QBTS a classic battleground stock.
Meaning high volatility is likely.
Very likely, especially around events like earnings announcements. Now, on the technical side, the stock price itself at $17.19 was trading above its 50-day moving average, which was somewhere between $16.29 and $16.78. That indicates positive near-term momentum.
And longer term.
Longer term, it was trading significantly above its 200-day moving average, which was down in the $8.15 to $10.53. That highlights the powerful upward momentum the stock has experienced over the past year, contributing to that 1,600% plus gain.
So putting it all together, it seems like the stock is trading heavily on a powerful narrative, perhaps more so than just the current performance or even the analyst targets.
I think that's a very accurate way to put it. What's fascinating here is the sophisticated dynamic of the market's reaction. The stock price is clearly elevated due to the narrative that D-Wave is capable of securing these large, potentially game-changing system sales like the one in Q1. And that narrative, that potential, has proven more powerful and lasting for the stock price, at least so far, than the actual cash generated by that sale. The stock is very clearly trading more on perceived future potential than on present performance.
Okay, let's shift focus slightly. Chapter 5, Ownership Structure. Let's delve into who actually owns the company. Who are the major stakeholders in D-Wave?
Well, looking at the ownership structure, institutional investors hold a pretty significant chunk, about 34.8% of the shares, held by around 422 different institutions as of our analysis date.
Any big names in there?
Yes, the top holders include the usual large asset managers, BlackRock, Vanguard Group, D.E. Shaw & Co. Also noteworthy is its inclusion in major indices like the iShares Russell 2000 ETF and the Growth ETF version. That provides a steady stream of passive buying support as index funds rebalance.
Okay, so decent institutional backing. Now, we touched on that insider selling earlier. How does that stack up against overall insider holdings, and what's the trend been recently?
Right, the insider picture is less rosy. Overall, insider ownership is relatively low, only about 3.20% of the company. And here's where it becomes, I think, a considerable point of concern for potential investors. There's been a complete absence of insider buying reported recently.
No buying, but selling.
Yes, and quite substantial and widespread insider selling, especially in the most recent quarter leading up to our analysis date. As we mentioned, May 2025 saw those big sales. CEO Alan Barat selling $14.4 million worth, CFO John Markovich selling $6.9 million worth, and the total insider sales over the prior 3 months exceeded $27.8 million.
That pattern of heavy selling by top executives, particularly at peak valuations after such a strong run, really does seem like a powerful signal, doesn't it? Raises questions about their conviction.
It certainly can be interpreted that way, yes. It's a data point that warrants careful consideration regarding management's view of the stock's current valuation and future prospects, and their alignment with shareholders banking on further upside.
And is the ownership concentrated? Is there any single entity controlling things?
No, the ownership appears relatively diffuse. While large institutions like Vanguard, holding nearly 9%, and BlackRock, over 7%, have substantial positions, no single entity holds a controlling stake. The ownership seems fairly broad, and the company is governed by a professional board and management team.
All right, time to look at the potential pitfalls. Chapter 6, Risk Assessment. Let's try to systematically break down the good, the bad, and the potentially ugly with a quick SWOT analysis. Strengths, weaknesses, opportunities, and threats for D-Wave. What are the key strengths?
Okay, on the strengths side. First, technological leadership. They are undeniably pioneers in quantum annealing with deep expertise. Second, their unique dual model strategy, being the only company seriously pursuing both annealing and gate model quantum computers, gives them flexibility. Third, that fortress balance sheet we discussed, around $815 million in cash post-offering, minimal debt, giving them a very long financial runway. And fourth, validated commercial traction. They have an expanding customer base with marquee corporate and government clients, which validates their tech to some degree.
Okay, those sound solid. What about the flip side, the weaknesses?
Weaknesses are significant too. Number one is chronic unprofitability. They have persistent losses, significant operational cash burn, and a highly uncertain path to ever achieving profitability. Second, they have a nascent market reliance. Their entire business is predicated on the broad adoption of a quantum computing market that is still largely unproven and in its early stages. Third, a high-cost structure due to the heavy ongoing R&D and sales and marketing expenditures needed. And fourth, revenue volatility, starkly highlighted by that Q1 2025 result, showing the risk of relying on single large non-recurring system sales.
Makes sense. Now for the upside potential, the opportunities.
Yeah. Opportunities are definitely there. First, surging market demand. They are positioned to capitalize on the growing global interest in quantum computing, especially for complex problems in AI, logistics, finance, and material science. Second, the government and defense sector represents a major opportunity as quantum computing is increasingly seen as a national security priority, potentially leading to lucrative contracts. And third, strategic acquisitions. Their strong cash position enables them to potentially acquire complementary technologies, market share, or crucial talent through M&A.
And finally, the external dangers
And
threats.
Threats are also very real. The big one is intense competition, not just from other pure-play startups like Rigetti and IonQ, but crucially, the existential long-term threat from those deep-pocketed tech giants, Google, IBM, Microsoft, who could potentially leapfrog them. Second is the risk of technological disruption. A competitor might develop a superior quantum architecture, perhaps an advanced gate-based system that matures faster than expected, eroding D-Wave's current annealing advantage.
Beyond the SWOT, how do broader macroeconomic factors play into D-Wave's risk profile? Things like interest rates or economic slowdowns.
They are quite sensitive to the macro environment, yes. High interest rates make it more difficult and expensive for pre-profit, cash-burning companies like D-Wave to raise additional capital if needed. Higher rates also increase the discount rates used in valuation models, putting significant downward pressure on the theoretical value of future earnings, which disproportionately hits speculative growth stocks. And general economic uncertainty or a slowdown could lead potential customers to cut back on spending for experimental R&D projects like quantum computing initiatives.
And what about specific geopolitical factors? You mentioned export controls earlier. How significant are those?
They are significant. Those stringent U.S. export controls implemented in September 2024, targeting adversaries like China and Russia, directly restrict D-Wave's potential sales reach and limit international research collaboration. Even though D-Wave is Canadian, these controls impact the global market they operate in, effectively shrinking their total addressable market.
Any other geopolitical risks? Supply chain.
Yes, supply chain disruption is a major risk. Quantum computers rely on a complex global supply chain for critical components, things like sophisticated cryogenic systems, specialized electronics, and rare earth elements. Tariffs, further export controls, or geopolitical tensions could increase costs and delay delivery. China's dominant position in the mining and processing of many rare earth elements, for instance, creates a potential vulnerability for the entire quantum industry, potentially leading to what some analysts are calling a quantum curtain, splitting the global market.
This has been quite the comprehensive dive. Let's try to bring it all together now as we head into the conclusion. Chapter 7. Conclusion. Can you synthesize our findings? What's the core bull case and what's the core bear case for D-Wave based on everything we've discussed?
Sure. Let's summarize. The key bullish points, the bull case, really center on D-Wave being a pioneer, a first mover, with a unique focus on quantum annealing that delivers practical, real-world problem-solving capabilities today. They are strategically positioned in a nascent market expected to be worth trillions in the long run. They boast that fortress balance sheet with roughly $800 million in cash, providing a long runway. And finally, the positive Wall Street sentiment and favorable media coverage are currently creating powerful momentum for the stock.
Okay, that's the optimistic view. What about the bear case?
The bear case is equally compelling. Grounded primarily in the company's extreme speculative valuation, that PS ratio around 257x is completely detached from current fundamentals. They suffered from chronic operating losses, significant cash burn, and a highly uncertain path to profitability. We also identified several red flags. The heavy insider selling by top executives at peak valuations, the extremely high short interest indicating significant bearish bets, and the fact that the recent massive Q1 revenue surge was driven by a potentially one-time system sale. And crucially, they face existential threats from deep-pocketed competitors and operate within an increasingly complex and restrictive geopolitical environment.
And revisiting the valuation summary, that DCF was inherently speculative, landing somewhere in a huge range.
Exactly. We have to reiterate that any intrinsic value calculation using DCF at this stage is highly speculative. Our educational model suggests a very wide potential intrinsic value range, perhaps between $2 and $25 per share, really just highlighting the profound uncertainty involved.
So where does the current share price of $17.19 sit within that context, and what's the concluding outlook?
Well, that current share price of $17.19 is clearly within the upper end of our wide speculative intrinsic value range. This suggests that the market price appears to have already fully incorporated a highly optimistic, perhaps even best-case, future scenario for the company.
Making it challenging for value investors.
For a traditional value investor, yes, the proposition is challenging. There appears to be a lack of any discernible margin of safety at the current price. And we've highlighted several significant fundamental and behavioral red flags: the persistent unprofitability, the extreme valuation metrics, and that heavy insider selling.
So the final thought.
The final thought is this. The investment case for D-Wave is undoubtedly a compelling, maybe even exciting bet on a potentially revolutionary future driven by quantum computing. But it is not, at present, based on our analysis of the fundamentals and risks, a compelling value investment.
That's a lot to chew on, definitely. It leaves us with a thought-provoking question, really. Given D-Wave's strategic bet on practicality today with annealing versus the broader industry's often longer-term chase for universal quantum computing with gate-based models, how much should an investor value today's tangible, albeit specialized solutions against tomorrow's potentially more powerful, but still largely theoretical, breakthroughs? And maybe more importantly, what does that mean for how you, the listener, approach investing in these kinds of emerging, potentially disruptive technologies? If this deep dive sparked some new insights or questions for you, definitely hit that like button and subscribe to the Stock Analytics AI YouTube channel.
Yeah, let us know what you think in the comments, too.
Absolutely. And remember, Stock Analytics AI members, it's just €4.99 a month. Get priority deep dives on tickers like this one. We're actually planning on covering all of the S&P 500 stocks over the next few months, and members get exclusive priority access for their stock suggestions in the comments section.
That's a lot of deep dives.
It is. And if you just want a one-off deep dive on a specific stock you're interested in, you can always drop us a super thanks on YouTube. And finally, the important bit. As always, remember this analysis was generated by an AI system. It's intended for educational and informational purposes only and should absolutely not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.